these are things that you need to really remember. And these are things that separate auction market traders from people that are doing all this other nonsense that's out there. And there's an increasing amount of nonsense. And remember, markets aren't should or shouldn't. I can't believe this market keeps going up or down, nowhere, because it should be doing this, because they're doing that, and they shouldn't be doing that. And the markets, if when you start going down that path, you're not a trader. You're thinking about things that don't have anything to do with trading. All you need to do is focus on the structure and the market condition. And if it is such that it's not tradable, don't trade it. Go find something that is. Understand, excuse me, markets are their own reality. And we want to think that we're smarter than the market, and that there's some, all the people on TV think they're smarter than the market, and all the analysts think they're smarter than the market. But the reality is that markets are elegantly consistent in how they determine value. They're more consistent, far more consistent than people making guesses based on fuzzy logic and metrics that are a moving target. So appreciate the market for what it is. It's its own reality, and that's what you have to trade. So if you will do that, that itself will begin to change your mindset and your worldview about what's going on. And it will also, give you a filter if you're, I can't tell you the last time I had CNBC on. I never watch it. It is not that I avoid it because it's going to change my thinking. It won't, but it's just a waste of time, frankly. I'd rather watch cartoons. Always default to something. This is key. This is the key. What I'm going to give you is the holy grail here, okay? The purpose of an auction market is to facilitate trade. Facilitation is carried out through the price discovery process. This involves a constant rotation and probing of prices that results in a defined range of relative value. Prices stay in the range until the consensus of value changes and either side of the market becomes dominant. And then you'll get a new dispersion of price, and another established range will begin. This process is in effect in all degrees of time, all the time. This is the holy grail right here. Every question that you have that you could ask me, the answers to those questions are right here if you really understand these 4 or 5 points about an auction market. There are very well-defined and specific areas of trade location where you have an inherent edge. And that's where you want to be trading. And that's one of the big differences between what we do and what everybody else does. Not all prices are the same. Most price activity is noise. Now, you will occasionally hear traders talk about, well, price regresses to the mean. Yes, it does, but value migrates. So what price regresses to, the mean that they're talking about, is the mean of value in that given range. And if that mean changes, it throws them into a tizzy because they don't recognize that the value of the market, they have no basis for understanding what's changing and why. You do. So yes, price is regressive as long as there is a general consensus of value, and that's that of relative value, where there is an area of greater value and then areas at the lower extreme, the upper extreme, of less value. And that's where you want to be trading. Trade opportunistically, learn to trade several markets in more than one time frame. Trade market structure, trade market condition. Remember that. I don't care what time frame you're trading or what you're trading, trade market structure, trade market condition. You're constantly trying to put yourself in the path of the highest probability situation at the time you're entering the trade. That's another way of saying there's an inherent positive expectancy. And the way you do that is to, okay, I can't predict what this market's going to do, but I can predict with a greater than random probability that somewhere in here where I'm entering this trade, within a range, and we don't have to fine tune it to a tick, that if I enter here and I give it this much room, that I'm going to get a sharp move, and if I'm on the right side of that, I should have a great trade. Now, when you're looking at trade locations, I'm constantly saying extremes. The obvious extremes are the extremes of an auction, the extreme of a range, of a balance area. But you can have different extremes. You can have time extremes. A time extreme is, in the Psychonex futures is around the opening or around the close. You can have larger degree structure, such as the high volume nodes. You can have an extreme in a market condition. If you have extreme vertical development, if you have an extreme mature balance area, like the NASDAQ. The NASDAQ has had two very extreme periods of horizontal development. And then the way you judge the potential of a trade is based on the above. And I know for a fact you've heard Troy talk about this, and a lot of guys that have been with us for a while will begin to understand, and Mike Pierre does this, will begin to understand, they come into the day and they'll say, well, I think today's going to be a rotational day. I think it's more likely to be rotational than it is trending. Well, why do you think that? Well, the reason you think that is because you have developed an understanding of this auction process, and that the auction process is also rotational in all time frames. Now, I have shown, most of you have seen me at one time or another show the decline that began in the fall of 2008. And everybody thinks, wow, if I'd only been, I can't wait to catch a decline like that and make all this money. Well, the reality is most traders, even if and when that occurs again, anticipate it occurring and trade in the direction that it occurs, are going to lose money because they don't understand the nature of the development of the market. Because if volatility picks up, you're going to get retracements that are, relative to what you're seeing now, extraordinarily wide ranges. So understand the market at this higher level through this lens of auction market concepts. And the other thing to do is really, really important for you guys, especially the newer you, well, it's always important, regardless of how long you've been trading. Focus on your process. Don't worry about a single trade. No matter how long you've been trading, it's easier if you've been trading for a long time to not let a loss or two or three or four, or a string of losses get you out of kilter. The thing that you've got to focus on is the process. If I have several losses in a row, I'm not concerned. If I continue to have losses, then I have to go back and say, now what are you doing? Are these good trades, or are you starting to get off the tracks here or something? In other words, am I following a process? Am I being consistent? Am I being objective? Am I trading from the extremes? Am I trying to force trades? Am I letting things set up? Am I finding minor degree balance areas that are located in the area of other key reference areas? All of those things are part of the process that I try to follow every day, the same thing that I try to get you guys to take a look at. And then be consistent to the best of your ability. And the only way to know if you're consistent is to keep records. If you will keep records and you will review those records, you will see where you're inconsistent. And we all get in, we all sort of, I call it getting off the tracks. I get off the tracks, Troy gets off the tracks, we all get off the tracks. But you want to be mindful of being consistent. And the reality check, once again, it's your trade records that helps you. It gives you concrete, objective information apart from what you think you're doing as to what you're actually doing, what you did. Chip, you say, can you expand on watching more than one market in more than one time frame? I find myself getting lost in the farce. You're somewhat systematic in how you monitor different time frames. Am I systematic in how I monitor different time frames? Well, yes, I am. I'm looking at, I start with looking at a daily chart, and then if there's a market or markets that I'm interested in trading, I'll look at those on a daily chart and probably a 30-minute chart, and that's pretty much it. And then if it begins to get interesting on that 30-minute chart, maybe go to a 5-minute chart. And that's it. It's nothing super sophisticated or complex. And sometimes, when I'm doing my homework at night, I'll pick 2 or 3 markets I may want to watch. Well, it's the one that I'm not watching that's going to work. That's also trading too. Chip, I don't really think it's realistic, especially if you're day trading, to really follow more than 2 or 3 markets. So if I have done my due diligence and I find 2 or 3 candidates, I'm looking on a daily chart, a 30-minute chart, and then drill down to a 5-minute chart if that 30-minute chart looks like it's setting up. And that's it. This is the topic that is never discussed, and it's never pointed out to people that want to trade, because it's reality. And reality doesn't sell nearly as well as magic, but it's true. And I think it's liberating to live in reality. Just because you don't have a lot of capital doesn't mean that you will not at some point be able to trade for a living. But it is completely unrealistic, and you're doing yourself and your opportunity a disservice to try to force making X amount of dollars because you feel like, well, if I don't make X, I'm not trading for a living. Well, I promise you, if you try to force things, you're going to lose all your trading capital. Most people, when they start trading, don't have nearly enough capital to be a self-sufficient independent trader. The most important thing you can do is to learn to trade. The most important thing you can do is to learn to trade, keep your trade records, and show progress. If you do this, another benefit of keeping your records is that you will attract money. Money will find you. And then when that discussion comes up, you can sit down with somebody and you can say, look, let me take you through what I've been doing for the past 2 or 3 years and how my trading has progressed and what I do on a day-to-day basis to monitor what I'm doing so that I make sure that I use proper risk controls, I don't over-leverage, I'm disciplined. Yes, it's discretionary. No, it's not systematic, but I am very disciplined. I have a specific methodology. I have a specific rule set, and here's my track record. Here's how I've progressed. Here are the rules I follow. Here are the different instruments that I've traded over this period of time, etc. I mean, that can be, if you do that for the next 2 or 3 years, I don't care if your account is $5,000 now, and in 3 years it's $7,500. If you do those things, you will very quickly begin to attract money, and you'll be able to go out and sell your ability to trade. If you don't have enough money to trade now, and you don't think you'll ever have enough money to trade, you can get it, believe me, if you will do these things. But it starts with learning to trade. You're never going to get somebody that has money to give you money if you can't show them you can trade. So learn to trade. And then another benefit of this, keeping records, develop your track records, not only so you can measure your results, which is the most important thing, because if you can't measure results, you can't correct what you're doing and get better. So this is another reason to keep your trade records. You say, what are some key metrics? Well, the basic ones, Chip, you want to keep your equity curve. You want to keep your drawdown, your maximum drawdown. You want to keep your the time to new equity highs and things like that. But those are volatility. The Sharpe ratio is something people are going to look at if you're trying to raise money. Some of the things that you're listing are more for your benefit than the benefit of someone that might be interested in giving you money to trade. But those are important things, the things that you're listing there. Sean, you say, how much is a lot? Generally speaking, 6 figures. Well, let me ask you this. Let me turn it around. What do you think a good return is compounded over 10 years? Yeah, that would be a good return. That'd be excellent, yes. 10 to 15% would be an outstanding return. Okay, so if we're talking 6 figures, let's start at the low end, $100,000. Can you live on $15,000 a year after taxes and pay your expenses? I can't. Okay, so that's your measure. Now, if you have $500,000 to trade and you make 10, 15% on it a year, and you can afford not to live on your earning, your profits, very quickly, that's going to build up. You see, this is something else that's promoted by the trading industry. It's not realistic. It's not realistic to think that you're going to compound at 40 or 50% a year. There are people that have done that and do that. And it can be done, but that's not something you should, if it's going to happen, it will happen naturally for you. And over time, if you're at, the most important thing you can do is not have big drawdowns. If you don't have big drawdowns, you'll have 35, 40% years, but it's not realistic to expect to have a 25, 30, 40% year every single year. It's just not. Now we're going to get into this a little bit later, but there are a number of instruments that you can trade that will help give you exposure that you've got to have to trade successfully without constantly over-leveraging your account. I can't overemphasize this enough. I know every one of you are sitting there and you want to trade to make money. But first of all, you need to learn to trade. And secondly, you cannot afford to focus on money. The thing to focus on is not losing the money you have. And almost all retail traders over leverage. They're encouraged to. They think it's the norm. Misery loves company. And this is just a mathematical fact. If you over leverage, I don't care what your edge is, you will lose all your trading capital. That's a mathematical certainty. That's not me guessing. All right, let's take a break, guys. Take 5 or 6 minutes, okay? Okay. You guys all set? Okay, there are when you go back, and I'm not going to say if you don't go back and listen to this over, not just this session, but these other sessions, I really, really encourage you strongly to do that. This was not intended to be something that you could just listen to one time, read the slides, put the slides and read them. You've got to go back. I promise you, the more you listen to these sessions, the more you will get out of it. And I think you'll find that will be true for the indefinite future. You will find that I repeat certain concepts over and over and over. I'm aware of that. I did that intentionally. It's really, really important that you understand the basics that you have seen throughout these sessions that have been reinforced in different ways and built on, whether you realize it or not. And you will realize it the more you watch this and the more you listen to Troy in the room and the more you read the reports and you listen to me in the DVSA. It will make more and more sense to you, because I promise you, if I'm anything, I'm consistent. And everything that I do that you see me talk about in the reports and in the trade lessons, the basics, the basis for it is in these 7 sessions. I can't think of a single thing that I discuss on a day-to-day basis or that Troy discusses on a day-to-day basis that is not in these 7 sessions and in it more than once. So I really, really encourage you to review this. Now, that said, every profession, and I don't care, you can name the profession, whether it's a science or an art or a sport or business. There are people in every profession that are just different. And these people are considered to be gifted by their peers of having something special that the others don't have, even though they had exposure to the exact same educational process, exact same opportunity, whatever. There's just something different about these people, that they've taken the same rules, concepts, material, and without violating the primary tenets of their discipline, they found a way to apply these things in a unique way that is their own. And because of this, they are just different, and they distinguish themselves from everybody else. Now, each one of you has the ability to do this in your own way. You know, I'm not talking necessarily about being the best trader, you know, in the group of people you know, or the best trader on the internet or anything like that. I'm not about being the best trader you can be. I think you can be better than each of you think you can be, whatever that is. You know, my goal for you is for you to be the best you can be. And this, what is going to determine that is not just the attempting to rote apply the rules, the concepts, and the guidelines, but to really understanding them and then to continue to work with them and to make them your own so that you are using them, and at the same time you're using whatever your gift is. And you all have some gift, you all have some ability that the rest of us don't have, or you know, you have more of an ability than the rest of us don't have. It's different for different people. And I think you guys know what I'm talking about. You know, if you think about golf or medicine or whatever your profession is. You know, this is a discretionary methodology, and the good news is it's a discretionary methodology as long as it is a discretionary methodology and it's just not a bunch of randomness. And I think you guys get the fact that this is a rules-based methodology that has a line of logic and is based in sound concepts, and it's based in structure, and you can define it. But there are ways within that definition and within that rule set that you can take it and really make it your own. And that will happen as you work with it. I think you will see that naturally evolve. Now, one of the things that is unique and outside the box, so to speak, is is to just do the mundane stuff. You know, keep records. How many times have you heard me say that? Keep records. Keep records. Keep records. Just please do that. That will put you in a unique category of trader. I promise. And if you work with me going forward, I've got to have that. And if you work with me, I can't work with you if you don't keep records. Yeah, I've told you before, and I'll say it again now. I got very good relatively quickly with determining when I mentor someone whether or not they were really serious about becoming a trader, a successful trader, and if they were going to be able to. And I could usually tell that in about 3 weeks, regardless of how much money they paid me or the duration of the mentorship. I could tell within 3 weeks if this person was really going to do it. And it was real simple. They either did the work that I asked them to do or they didn't. So the most important thing you can do that would set you apart is to, do work. This is work. Keep records. That's part of it. And I want you to stay focused. Commit to this process. Give this your best efforts. I don't want you to take this and say, okay, now I've taken this course from Tom Alexander. Now I'm going to go run over here and I'm going to take a course in how to trade Bollinger Bands and RSI and Fibonacci. And then I'm going to put those two things together and see how it works. That won't work. I want you to stay focused and commit to this process. You owe it to yourself. You paid for this. And this will work if you will commit to it. But it's not something that, tomorrow morning now, you're not done. You're not ready. The work is just beginning.